We're very confident that we will be in the 3 to 5%. We've actually flagged to the market that the first half would be lower on the count of lower pricing and then picking up in the second half. What you see behind these results is actually a strengthening again of the volume component, which for us is the most important. I also think that this volume component drives the enormous financials that you see. Gross margins again up very strongly, underlying operating margins up 80 basis points despite higher investments in BMI. Earnings per share as a result on a constant basis nearly up 18%. So the internals of what we are producing here are actually very good results, and we see the overall sales parts accelerating over the second half of the year to stay within the 3 to 5% range.
You're bullish about your volumes increases, but shareholders and analysts have said they're quite concerned about weak pricing in your sector and also at your firm. You've got to 0.2% price growth, slightly improved from last quarter. Do you anticipate these very competitive market circumstances will continue to keep that number low?
When we had a lot of pricing, analysts were worried about us not having volume. Now we have 4 quarters in a row continuous volume expansion. Now some analysts are worried about our pricing power. I just wonder if they're always worried about something, and that's fine for us. We think that we can manage that mix moving forward. Pricing will slightly pick up over the second half, and that is probably one of the drivers why we feel confident that we end up in a 3 to 5% range.
Doesn't look like currency markets have been much kinder to you this quarter than they were last time round. Do you think you could have done more to mitigate that impact?
Currencies are very volatile at the moment because the geopolitical environment is very volatile, and we have to deal with that. We see enormous currency swings, and we're actually entering a year again with significant negative currency impact from the emerging markets that we have to deal with, and eventually that will reflect itself as well in pricing in these markets. You see behind these results that our overall growth in the emerging market is up over 4%, so it's a strong underlying growth despite these challenges. Many of these markets are stressed now. You take markets like Turkey, take markets like Mexico, you take markets like Brazil, with uncertainties, election results, their economic policies are just not getting through to the consumers and improving their standards of living.
You're obviously aiming for an operating margin of 20% by 2020. Looks like you're now at 17%. You're on track, you say. What are those other challenges that could prevent you hitting that target, do you think?
Well, we're not only on track, we're actually ahead of our glide path. Again, there were some people skeptics out there, you cannot get to a 20% margin. We have very strong brands. 85% of our business is in number 1 and number 2 positions. We have significantly accelerated our innovation program. What you see here is with a gross margin expansion that is quite healthy at 60 basis points. It's entirely driven by our innovation program and mix, and not actually by pricing, as you pointed out. So that shows you the strengths of what we're trying to do. So if we keep our innovation pace, which continues to increase in this company, and work the mix as we are currently doing, just gross margin expansion alone will get us there and still allow us to invest more in brand spend. That's the beauty of these results. We've again spent 20 basis points more in brand spend to strengthen our brands behind that. So that's how you have to run the business. And I think we're continuing to stay on the glide path to the 20% margin by 2020.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.